Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market analyst, Curtis Scouten. Jumping into the charts here on this August 23rd, touching base on the S&P, the QQQ, gold, the US dollar, interest rates, and also we'll touch base on oil and natural gas. Interesting price action. We saw weakness in the markets again today. And this is very concerning. There were little pockets of strength, specifically in the energy sector, and that's probably part and parcel because we saw a significant decline in the dollar. And when we look at the dollar, let's just briefly touch base on that first. When we look at the DXY, you can clearly see it hit that double top resistance, which is why we started going long a variety of commodity-based plays, because we directly know that commodities, when there's a rising dollar, commodities have a tremendous amount of sell-side pressure on them. When the dollar starts to pull back, that's where commodities catch a bid. You saw it with silver, you saw it with gold, you saw it with copper, and that's why we picked up the likes of like StoneCo, STNE, which is an emerging market play. And from simply one day ago, when we look at STNE, we're already up almost 9%. I was very close to hitting the sell side pressure because when we picked it up yesterday at 856, we're almost up 10% on this trade in one day. But I do think there is more upside. This company is based in Brazil, and they're completely been battered down, almost 90% down from the highs, which means that a mean reversion candidate is very, very likely for this company, especially as you can see this type of pattern is actually forming a base. It's a rounding formation, and not to say it can't go lower, but this is actually turning out to be healthy. It's a rounding formation where you've put in two major pivots, and now it's looking to be you're putting in a series of higher lows. So this could be a potential basing formation just due to the fact that it is completely demolished. And the interesting thing with a company that's in Brazil, once the dollar does pull back more, it should inevitably give it some legs to potentially rise even more. And that's certainly what the equity markets were supposed to be expecting as well. There were pockets that did well, but overall it was only energies, industrials, and builders that were up. And most of the other things were down. Dow Jones transportation was down, and broker dealers, that's a pretty big catalyst, down 2%. And that's something to really pay attention to. Generally, broker dealers will lead the market higher and lower as well. And if they're doing very, very weak, if they're showing relative weakness, that could be that there's underlying risks in the market. And I do think we still could see a little bit of a pullback in the dollar, but clearly there's been strength under it. Where I'm expecting the dollar to pull back to initially before it gets maybe a potential bounce is this 107, just above 107 area. You can see you have some nice, beautiful wicks and flat tops over here. So I think that's going to be the level where we see somewhat of a potential support on the dollar. But if it pulls back, you'll still see the equity market supposed to catch a bid. But the disappointing thing about the S&P is that it's still finished down on the day today. You can clearly see it was up and then it reversed and gave back all of the gains. And it hasn't filled this key technical gap to the downside here at 411 and change. And it has not filled this key technical gap here at 408. So considering that it did hit the short-term 25-day moving average, it's still very, very disappointing that the S&P closed negative on the day when you had the dollar pull back. Typically, yes, the dollar has been on a rampage and very strong, but you really wanted to see the equity markets catch a bid from the dollar falling, and that's disappointing. It shows relative weakness that even with a falling dollar, equities weren't able to really catch a bid as a whole. Like I said, certain sectors and pockets did, but as a whole, you really should expect to see the markets bounce as the dollar pulls back. If we're taking a look at the QQQ NASDAQ, you can clearly see that we've also had this beautiful sell-off. You did fill this gap yesterday, and you're kind of teetering around that same level. You can clearly see that you rejected intraday action off of the short-term 25-day moving average. So this has relative weakness, showing that tech is actually trading below its 25-day moving average, where the S&P is actually holding. So in the short term, that is relative weakness. I still think we can catch a bid if the dollar continues to fall. Then we could potentially start to see, and if interest rates pull back, which I do think they're kind of extended in the short term, that could coincide with a bid that the tech risk play or the tech assets could catch with the dollar falling and yields falling in the short term. Not to say that they're not going to go higher, over the medium and longer term. It's just in the short term, I do think they're should be pulling back for some sort of consolidation, digestion of the pattern. Let's take a look at natural gas. natural gas is amazing price action. You can clearly see our daily topping tail over here. That's kind of been our line in the sand where you draw a flat trend line across, you failed to confirm above, failed again, you put in 2 reversal signals, which on volume, which gave me the sell side signal that, hey, natural gas is unlikely to go much further. Even if it does go much higher, we still have maneuverability, tons of maneuverability, and we're actually in the money now on this natural gas trade, considering we shorted in pre-market via the KOLD right at the highs a couple days ago. So beautiful to see that natural gas made a new high and failed to basically hold that high. And there was news that came on the back of natural gas. For instance, let's just take a look at the intraday drop. So this is when the news came out. You can clearly see on a technical basis, someone already knew something. The dumping began. You had a massive spike, beautiful reversal topping tail. This would have been your intraday signal right here, and this would have been your intraday confirmation. On volume, you could have basically got out of natural gas if whether you were long or short, or most likely if you were long. If you're short, you wouldn't have gone out. But if you were long natural gas, these 2 intraday candles right here would have been your signal to confirm that this pattern was likely going down. And it's amazing how fast that news hit. And look at the volatility, boom. And now natural gas is making a bear flag. And the news was something to do with the Freeport facility. I don't think they were meeting their deadline or their target date in terms of reopening and allowing natural gas to flow back to Europe. And this is kind of what we touched on. You know, you wonder how much of this is actually politics, where, you know, the likes of America and Canada and North America as a whole, we don't want to see natural gas at $9.20, or at the highs you're almost near $10. So our governments, you know, and I'm kind of speculating here, but our governments now at the point where, again, at these highs, you're going to continue to see these headlines that push natural gas down because they don't want to cause this domestic damage and kill and raise their inflation rates. They would rather just keep sending that inflation to other countries where, you know, they're trying to help these other countries, but at the same time, you know, you can't really help a drowning victim. And unfortunately right now, just due to the lack of policy and energy policy globally, Europe is kind of a drowning victim against the Russia energy crisis, and it's not going to be an easy road ahead for them, which is why we're positioned for global recession, because there's just too many catalysts, with Europe sinking, Japan, with China potentially, even though they're starting to stimulate with the lower inflation rate. Too many catalysts on the horizon that for us to be bullish on this market for the long term. Looking at oil, WTI had an impressive move up over, I think it was close to 3% on the day, moving from 90 all the way to 93.30 and change. You can clearly see you're at a little bit of tiny resistance. Now, I do think you're going to break through this resistance. One of the reasons why is this was our original pattern where we shorted, we broke down. You had to retrace back to this resistance zone. And since you've hit this once, made a new low, and now you're testing that resistance, I think we actually get through that resistance. And yes, you may have a little bit of support a tad bit higher on the 200-day moving average, but I think we have the potential to slice above there and potentially test this upper orange line, or we could potentially start to see some resistance just piercing the 200-day. So nevertheless, I do think we're going to get a potential update on over the next day or two, where it may give us an opportunity to short. If oil came pushing all the way up to maybe the 50 or this orange line, connecting this pivot to this pivot to this pivot, I would probably consider shorting. And just to put into perspective, I think these two lines might converge, and that looks pretty darn good to me, in the sense that if we get that technical retrace up to where this might meet, which is shaping up to be somewhere in early September, maybe sooner, I might execute that short, just because you have resistance here, and tons of pressure coming down on oil at this point in time. But I do think oil will head lower to the 76 before it gets a really robust bounce, potentially a multi-week bounce. But at that point in time, we'll have to reassess, and hopefully we can catch a long trade as well, because I do think energies will eventually get that long trade opportunity. If we look at the XLE, it's getting extremely extended. Let me just remove all that. So you can clearly see that XLE has now had almost a retrace, a 618 retrace of this down move, which is pretty healthy to note. You've filled some key technical gaps on the way. So you have one here. Let me just remove this trend line over here, which is now what you're trading at. So if we flip to where we are in the XLE, you've had a perfect retrace. you're coming now into some resistance. Potentially another float to this 84.85 level would meet the top of this channel, where you have a pivot low to a pivot high. That would be a good resistance point to maybe start accumulating a short if it went right up into that area. Now this is your intraday action. So short term, this is bullish consolidation on the XLE, and you actually broke out of that in the after hours market. You had your retrace, now you've confirmed and gone higher in the after hours. So potentially in the short term, this does favor more upside on XLE. But again, if we get a straight shot into, say, this, I'm going to be looking to short a variety of energy names, potentially the XLE sector itself as well. So stay tuned, be on alert for potential energy shorts. We have banked tremendously on energy this year, multiple times, rinsed and repeat. So if we get that opportunity again, I'm certainly going to take that if the charts tell me. We did buy GSK as well over here. It's forming a beautiful, trying to form a reversal. From my point in time, every time you see a massive buy volume candle after a major gap down and sell off, generally these buyers that bought in this candle are still continuing to accumulate as the over leveraged sellers and people who are caught up at the highs start to dump the stock. So this is in a beautiful accumulation zone, you know, a pharma play. I think you've broken this resistance and this resistance too quickly. I do think at the minimum we're going to get a retrace back to this area, a mean reversion bounce, technical bounce, just due to the fact that this is more of a defensive play in the markets, and it's just been completely obliterated on the fact of news-based events. But the news always tends to take it lower than most people think. But when you have a capitulation candle of 35.93 million, it's very difficult to say that there's not buyers buying in this range, because that's an incredible amount of shares. That's actually probably the most daily shares that GSK has traded since its inception, which is something to truly behold and just appreciate and try to analyze. So to me, there's tons of buyers buying down here. The fact that we've started an accumulation position here, we also bought right at a technical gap fill level around this 33.11 mark, and that is just extremely oversold. This is a company that makes tons and tons of money. They're not going to go out of business anytime soon. You know, they have these massive dives, but they also have these massive rallies, massive dives, big bounces, and this is a complete oversold bounce. You know, you've had basically over here 1, 2, 3, 4, 5, 6, 7 out of 8 down candles, a gap 9 days, another gap down 10 days, pretty much 10 consecutive downside pressures down without even having a mean reversion bounce. So if we simply take it from that high, you've fallen 21%, and I think we get at least a bounce back to this 36 level, and potentially a retrace to the breakdown zone, which is this trend line, which connects this pivot to this pivot to this pivot. It's very rare where you have a multi-year trend line that connects pretty powerful pivots, the COVID bottom to over here, where you just gap over that trend line. So naturally, I do think price action will retrace, and we'll certainly, I think, be able to profit on this trade. Our next ad level, if it goes lower, is another technical gap around 32. And then we have our big trend line, which I'm watching over here, which takes us back to 2015 lows, 2018, COVID, you know, almost your COVID double bottom. So that would be a pretty impeccable level to continue to accumulate at. Let's take a look at gold. Gold's interesting as well because it was ripping early in the morning along with silver. You can clearly see that we were saying you had 6 down days in a row. Likely the 7th is a bounce. You're at support, which also favored a bounce. The question is, we just didn't know how big that bounce is going to be. Clearly you see that you've bounced. You tested the resistance here at the top of this channel, and now you're starting to pull off and close a little off the highs. But the fact that we closed higher than the previous intraday low over here, that is something the bulls should really be proud of in that sense. And if the dollar can continue to show a little bit of weakness in the short term, gold could come and test the top of this channel around 1796. Or if we extend this channel down lower, you'll have a little bit of support just before that level around 1780, 1775, give or take. So gold has some work to do. It's up against a surging dollar, which certainly is never an easy catalyst to defeat. We also have the Jackson Hole meeting this week, where we'll hear Powell discuss potentially giving new signals to the bond market. And clearly the bond market has an exceptional move, clearly broken out in the short term, had 1, 2, 3, 4 powerful days in a row to the upside. You're into resistance now. There might be potential that you come up to this area over here, which you can see you almost tagged today, but you're at resistance nonetheless. You're at the center point of this channel, which yields have been trading in for quite some time. Basically, you can see pivot highs to here, lows, lows, highs, highs, and now you're at the center point. So there's this neutral resistance at this level, and I think yields aren't going to move much, just depending on how the Jackson Hole meeting goes and what Powell's insights are. So let's just continue to monitor that. I am curious to start looking at accumulating UBT, or even adding to the IEF, kind of those long duration bond plays. But I'm hoping that yields can squeeze up a little bit higher. Maybe we get some sort of a fake out where yields push higher in the Jackson Hole meeting and then they start coming down. So that's kind of the price action that I'm going to look for. I'm hoping that I can start accumulating the UBT around this level. This is my first resistance that I'm comfortable accumulating bonds at this 3.15. I'll probably start off with, a decent chunk of my portfolio just to get some of that exposure. But we'll just have to continue to assess and watch how the yields move. That's it for today's video. Hope Pulse Analysis helps. We'll continue to try to print some profits. We did close one winner today, our TJX short. So awesome job on that. It was one of those things that popped. I believe it was on earnings. And in this type of environment, yep, it was on earnings. We shorted at the highs here. We had multiple factors into resistance, retrace of this down move. So many factors. We netted a beautiful 7.2% in like 3 or 4 days. So the reason sometimes I close trades out very quickly is just because of the price action, how quickly it descends over that period of time. And it just takes away from our borrowing rate. The less amount of time you can spend in a short position, the more profit that's going to be, because all of our brokerages, we pay borrowing fees, and at times they can raise those borrowing fees within that very same day, just depending on what the stock is. So a lot of the meme stocks sometimes will have incredible borrowing fees. Other stocks will have higher fees. So the quicker you can get out of a short, the better. You take your profit if they give it to you and you run. And that just means you're going to be paying less borrowing fees, less time in the short, less risk. Just take your profits. But naturally, TJX is at a little bit of support. You can see all these pivots here. You also have the short-term moving average. So I'm expecting the markets to actually get a bounce, believe it or not. Like this S&P 500, I think we may get maybe a little bit of a down day to fill this gap. And then I think we get that little bit of a bounce up, at least to this 50% retrace zone again, maybe even filling this gap. I'm in the camp that we should fill this gap at some point. But again, it's not what I want. It's whatever the price action is unfolds that we just have to trade against. So again, awesome job. Congratulations on the recent profits. We have been continuing to grind this market higher. Our portfolio is higher. I just hit a new milestone today, and most members, if you've been taking the trades with us, would have also hit a new milestone today. So let's continue to trade wisely and try to decipher all this information that's coming at us all the time, and try to stay ahead of the curve, and most importantly, away from the herd. And let's just continue to try to maximize these profits. Take care, everybody. Please give this video a big like. And if you're looking for any additional information, I continuously post things on Twitter at Trading One Capital. I continue to post things on Instagram at Trading Capital. And I also, obviously, the YouTube channel and the website. More importantly, I post additional insights on the website for subscribers only, where there's, just a little bit more in-depth analysis of certain charts. And ultimately, these videos are going to be the most educational. And that's all I try to do here, is just provide education, insights. Clearly, whatever I've been doing this year and previous years is starting to play out tremendously. And when you factor in that a lot of investors are calling this an anomaly period, being the fact that the anomaly is equities and stocks are also going down the same time bonds have been going down. And this is what people have to realize. This anomaly could last potentially longer than most people expect, due to the fact that we've been breaking correlations every which way from Sunday. We've been breaking correlations with the euro and the dollar, hitting new lows, I believe yesterday, breaking parity in over 20 years. We've been breaking yield rates over 40-year trends, 50-year trends, might I add that. We've been breaking inflation rates over 40 to 45-year trends. We've been breaking the amount of stimulus that we've printed. We've been breaking the record amounts that interest rates have raised in a short period of time. We're breaking records with the yield curve inversion. So there's just so many factors that are pointing to lower lows in this market. And I do think we're going to get that at this point in time, but I do think we get a small little technical bounce that'll be able to rope in some more investors. And a lot of people would still deem this kind of a bullish pattern, this rise with this fall. This fall is no longer a bull flag. You've had too steep of a fall. The pattern now, what I'm going to be looking for, are we going to get some upward sideways flagging consolidation? That's kind of the pattern that I'm looking for. A nice bear flag off this level, similar to this, where we had this exact same pattern. You had chop, floating, grinding up, and then the sell side just came. So that's what I'm expecting, is a nice little bit of, chop higher, a little bit of chop before breaking lower. Okay, so let's please give this video a like and a comment down below, and we'll see you on the charts tomorrow.